All right, welcome everyone. We're going to give folks a couple minutes to join. We're really glad to have you. Let's just give it another couple of minutes and then get started. Thanks for being with us today. So just a few housekeeping rules. Everyone is going to be on mute. Once our speaker begins to talk, he's going to have the floor for say about 45 minutes, and then we're going to open it up for Q&A. So please make sure that you're in a quiet place once the Q&A starts. And also just to iterate, this is going to be recorded, just so everyone is aware, and will be made available after the session. We'll give folks another couple minutes to join and we can get started. We have people trickling in, so we'll give it another few minutes. Okay, we can go ahead and get started. Welcome to the Trove webinar series. My name is Desayo Ajishagiri. I'm a co-founder of Trove Finance. And today we're going to be listening to my very good friend, Dr. Chuck Okolie, who is an incredible investor, extremely experienced and learned. He's been in the markets for a long time and my personal mentor and tutor. It's with great joy that I introduce Chuck to teach us a little bit today about how to build a great portfolio in a volatile market. Just some housekeeping rules, just to reiterate. Everyone is going to be on mute except Chuck. He's going to be talking for about 45 minutes. And after that, we're going to open the floor for Q&A. And during that time, you'll be able to put your questions in the chat. I will be moderating. If we have some time later on, we can maybe have a dialogue of some sort, but we need to have an order as to how we're going to make this work. So if you have any questions in the meantime, feel free to put up your hand in the chat, and then I can take them and can work from there. But ultimately, we do not want to disrupt the instructor as he talks to us today. So let me know if you have any questions. You can ping me directly or leave your comments in the chat section, and I will monitor that. All right, without further ado, I would like to introduce Dr. Chuck. Over to you.
Hey, Desai, can you hear me?
Yes, absolutely.
Oh, okay, perfect. Yeah, thank you for that very generous introduction. Yeah, before I get started, I would just like to give a very brief introduction or background about myself. So like Desai said, I'm Chuck. So I'm a chemical engineer by training. I'm not a finance guy. I'm not a business guy. I met Desai while we were pursuing our bachelor's degree at Howard University, and since then I've gone on and I went to Georgia Tech. I got a PhD in chemical engineering as well, and I've been in the energy industry since then. So I mean, I'm mostly focused on renewable energy. So I mean, if any of you on the chat follow the energy industry very well, you might have heard that a certain refinery here in the U.S. is focusing or is planning to repurpose one of their refineries and convert it into a renewable plant that will go online in 2024. So it's going to be the biggest renewable refinery in the United States. So instead of processing crude oil, we'll process used cooking oil. So your vegetable oil that you use for cooking or for frying your chicken or whatever, we'll process that and use that to make fuel. So that work was inspired by some of the work I'm doing with the company. So that is what my background, that is what my expertise is on. I mean, my participation in the market was mostly fueled from personal interest and my curiosity, and in fact, just trying to build wealth. So the purpose I'm bringing this up is just to mention that, number one, anything I say here shouldn't be taken as financial advice. I'm not going to give recommendation on any stocks or maybe tell you how to invest your money. I will just share with you some of the things that I have done with my own some of my personal strategy I have done to build my own portfolio, which is actually has been quite successful. And the second reason is that you don't have to have a financial background to be successful in the market. So that is the second thing I would like to emphasize here. I do not have a financial background. I'm an engineer, I'm a nerd, an engineering nerd by training. So you don't have to have a financial background to be successful in the market. You just have to dedicate and put in the work, and anyone can have success in the financial market. So those are the two things that I want to bring up before I go ahead and get started in my presentation. So don't take anything I say here as financial advice. If anyone see me, this video is proof. This is my disclaimer. I'm not giving financial advice today. So with that, I'll go ahead and get started. So when Desayo approached me to talk to the Trove folks, I mean, about investing strategies and all that, she gave me two topics. And I remember when she gave me two topics to choose from, I was in fact on the treadmill running at the time. I think I was halfway into my run, so I had about 30 minutes. And I used the rest of the time to kind of ponder on what I was going to be talking about. So the two topics that she gave me, one of them included strategies for maintaining or building a great portfolio in a volatile market. So I was thinking about what I've done that was different from my initial strategy. I mean, I used like the 30 minutes in my run to actually think about what I've changed in my strategy. And what I concluded after that run was that, in fact, I've done nothing. Nothing has changed. My strategy has remained exactly the same. And if you hear me out, I'm going to explain to you why I, in fact, not changed anything. So I think that the timing for this seminar couldn't have been any better. I mean, obviously, the market has been very volatile. There's been a lot of uncertainty, most especially starting in the beginning of the year with COVID-19. and the economic difficulty that it brought with it. And now we have the United States election coming up. So you see, with things like that, we have uncertainty, and the market hates uncertainty. That is what causes volatility in the market. So this is a very good time for this talk. There's a lot of volatility in the market, a lot of uncertainty. So how do we actually manage our portfolio in this volatile market, in this time of uncertainty? So that is what I will mostly be talking about today. So what I came across was that there are 4 mistakes that investors make in a volatile market. And one of them specifically is actually changing your strategy based on the short-term volatility. So that's a big mistake that a lot of people make. Change your strategy. The second one is most people focus too much, put too much focus, put too much priority on the short-term volatility. So that's another very big mistake that a lot of people make. The third one, which is actually very common, most especially with retail investors and with people that are newer to the market, is panic selling. I mean, that's the worst thing you can do in a volatile market, panic sell. So, and the fourth one is pressing pause on investing. So most people say that, okay, this market is too volatile, there's too much uncertainty, I am not qualified enough to invest, so I'm going to pause and wait for things to stabilize before I continue investing. And that's a mistake that you also make in the market, because with volatility comes opportunity, right? In fact, I get this question a lot. Like, people ask me, oh, Chuck, when is the next market crash going to happen? When is the next recession coming? When is the next market correction, etc.? Honestly, the answer to that question is I don't know. I don't know when the next market crash is coming. I don't know when the next recession is coming. If I knew, I'll probably not be giving this seminar today. I'll probably be on a yacht vacationing, right? Because I have made a lot of money. So, but the thing is that I can tell you what to do. I can tell you how to prepare for this market crash when it eventually comes. So hopefully with this presentation today, you kind of have some idea of some of the things that I have been doing to kind of prepare for a volatile market and for a market correction or a crash, if you like. Desayo, if you want, I have one slide that I would like to use to facilitate this discussion today. So I don't know if I can share my screen. Okay, yeah, it's letting me do that now. I tried doing it before, but it didn't let me. So give me 1 sec. Let me share my screen real quick, and then we can use that to facilitate the rest of the conversation today. Can everyone see my screen okay?
I might need to stop sharing, so let me pause my share.
Okay.
Then I think you can give it a shot.
It says I'm sharing my screen right now, so
I cannot see it. Guys, can you see the screen? Because I can't see it.
yeah, let me stop sharing and try sharing again.
Okay.
Maybe that would help. I still see your screen, so maybe if you stop sharing yours and then I try sharing mine.
Okay, hold on. Let me give this a shot. What about now?
Okay, so give me 1 sec. Yeah, let me try sharing mine now. Let's see if that works. So do you see my screen?
Yes.
Oh, perfect. Okay. All right. So in managing my portfolio, so there are 4 guiding principles that I use. So these are my 4 strategies. And I think that if you go by this strategy, you can't go wrong, really, because at the end of the day, the market goes through ups and downs, right? I mean, there will be corrections every now and then in the market, but if you go through this strategy in the long term, you always come out winning. So what I have named this strategy is GAME, G-A-M-E. And I am going to go through each of these acronyms, or each of these letters in this acronym, and I'll tell you how I apply this, or how you can apply this in managing your own portfolio. And what I want to say is that if you do this, this strategy doesn't have to change in whatever market conditions that we are facing. So stable market, volatile market, recession, market correction, this strategy applies in all of those market scenarios. So that is the good thing about this. And I hope that, I mean, at the end of this section today, you'll be able to get something out of this and maybe apply some of these strategies in your own investing and make you more successful investors, at least. That's the hope. So GAME, G-A-M-E. So what do each of these letters of this acronym represent? It's very easy. I made it very easy for everyone to follow. So GAME, you can't forget that, right? So I'm going to start. I mean, they don't all go chronologically. So we're going to start from M, which is the first one. And what does M represent? It means make time. So that is the first thing that I cannot emphasize enough. To build a successful portfolio, you have to be able to commit some time and energy into actually looking at the companies that are going into your portfolio. So you have to make time, learn, educate yourself. So if you want to buy a certain company, a certain position, a certain stock, you have to do your research. You have to make time to learn about the company business, at least have an idea of what the company is doing in the, at least on a high level, right? Know who their competitors are, know who their customers are, know what market they are trying to serve, and know what kind of disruptions can happen to that market. If you can do those 4 things, I mean, you cannot go wrong. That will give you an idea of whether or not that is a good investment, right? So an example, you want to invest in a company called, let's call it Samsung, right? And then you look at Samsung business. Oh, it's very good. You have a Samsung phone, right? So what are the potential barriers that Samsung can face in the future? You have to be able to know, I mean, how the company makes money and what amount of presence the company has in the market. And I mean, if they can be disrupted, because that is another, I mean, obviously we are in, technology is taking over everything right now. So, I mean, things can change very quickly, right? So what is the switching cost that Samsung has implied on their customers, right? Can their customers tomorrow switch to an Apple phone? I mean, what is the barrier that Samsung have put in place to prevent their customers from going into another company, right? So you have to know all that. You have to be able to make time and learn about the company that you're going to invest. You have to do that. You have to know their business on a high level. I mean, for myself, I mean, I'm more of an academia. I like to take fundamental approach on everything. So I go even deeper, right? But you don't necessarily have to go into all the weeds of what the company is, but at least you have to know what their business is. And then after knowing what their business is, you need to know how the company make money and how the company has made money in the past. So in that case, you have to go to the company, look at their financial statements. I mean, companies that are trading publicly, they are required to disclose their income statement and their balance sheet every quarter. So 4 times a year, a company will give you an update on how it's performed that quarter, right? So you have to be able to look into that statement, look into the company's financials, and see how the company is actually handling their money. I mean, obviously, you don't want a company where the CEO is buying a yacht, where the CEO is buying vacation houses, whereas the company is in huge debt, right? You can tell that from looking at the company's balance sheet and the company's income statement. So those are things that you need to be able to, you need to dedicate time to actually learn about the company before you put it in your portfolio. The biggest mistake investors make is FOMO, fear of missing out. They see a company go up 5%, 10%, 20%. And because of that, I mean, they are afraid. They're like, okay, now I have to own this company. Now I have to buy the stock because it's been going up so much. So I don't want to miss out. So they go buy the stock without doing their due diligence, without actually even looking into the company. And the funny thing, though, is that is because of that, those investors that fear that FOMO buy, they're also the same people that FOMO sell. Because the thing is that once the company starts to sell off, since they don't actually know the fundamental of that business, since they don't actually know what the company actually do, or they don't actually know what the future holds for that company, they sell. So what happens is that you end up buying high and selling low, right? Because you FOMO bought. You bought the stock because you saw that it went up 50% within the past week, right? And then you buy. And then the smart money, the people that actually bought it when it made sense to buy, they begin to take profits out. And then the stock falls. And because it's falling and you actually didn't know what the business was about, you get scared and sell out yourself. So that's a problem, right? It's not sustainable. You can't sustain a portfolio with that mentality. So you actually have to make time. You have to make time. There's no way around that. So I can't emphasize that anymore. So make time to actually look into the company and make time to actually educate yourself. So obviously, it's not like looking at the company, looking at their financials, it's trivial. It's not rocket science. But at least you have to educate yourself and see what each of those metrics in their income statement and their balance sheet actually mean, right? So let's say a company says that it's increasing its cost of revenue. What does that even mean, right? You need to know all that. So that is one thing that you should do. So make time, very important. You can't actually go around that. There's no way around making time. You have to get the right information before you make any investment. There's no way around that. So the second one is get the facts. So this kind of ties back to the first one, which is make time. So you have to get the facts. You have to get information. So there's something that I would like to say. The market, how does the market move? What determines how a stock trades today? What determines that is essentially information. So a stock trades based on the information that is available on that company. So the assumption that you have to make whenever you're looking at a stock is that every information that is out on that company is already priced in, right? It's called the efficient market hypothesis, essentially. So the efficient market hypothesis posits that a stock basically trades on the information that is available on that stock, on the underlying company, right? So basically, every information that is out in that company is essentially already priced in. So what this hypothesis basically means is that if a fund manager, right, decides that he is going to predict the next movements of a stock, the fund manager always fails at that mission. But then the good news is that that is not always true, right? Like, I mean, hedge funds, fund managers, they predict stocks all the time. They pick very good, they pick winning stock all the time, and they actually succeed at that mission. So the good news is that although that hypothesis states that information is always priced in, it is not necessarily always the case. And that is for two different reasons. So the first one is liquidity. So the efficient market hypothesis, for that to hold, it means that liquidity has to be perfect. So for a stock to trade, for the market to be perfectly efficient, liquidity has to be perfectly efficient as well, which is not always the case. That is why a fund manager, for example, a seller of a stock, trying to sell a very big portion of his stock, right? For him to sell it at the efficient price, then there has to be someone that is willing to buy it at that price, right? That person has to have the liquidity at that particular time to pay for that stock at the price it's offering. But that is not always the case. So that usually leads the fund manager to offer some kind of discounts, right? Some kind of discount to sell his shares. Because liquidity is not always perfect. So that is one thing. The second is that the interpretation of information is also not always perfect. So investors, we are human beings, and human beings are not perfectly rational people, right? We are not always rational. So because of that, there's usually misinterpretation of information. So that is usually how funds, fund managers, and hedge funds make money. And as a matter of fact, as an individual investor, as a retail investor, you can use that strategy as well to make money. So the idea here is you have to look for market anomalies, right? So for example, in fact, there's a very good example that I am right now. Apple reported their earnings 2 days ago. So in that earning report, they had beat analyst expectations. So they had reported very great earnings. I mean, they beat analyst expectations. They grew their revenue, grew their net income, grew their earnings per share. Everything was good. But then the stock fell over 5% the next day. Why? So this is because Apple reports different earnings from different segments of their business. And Apple, you know, they have a very diverse set of business. They have the iPhones, they have Mac, they have wearables, they have services. So apparently the Mac and wearables did very well. Services did very well. Every other aspect of their business did very well. But then their iPhone fell below analyst expectation. And because of that, investors sold the stock. So why does this not make sense, right? This doesn't make sense because obviously this is the third quarter. Apple just released their new segments of the iPhones, the iPhone 12. So what usually happens a few months before Apple releases a new phone? Customers know that a new phone is coming, right? Customers know that a new, better phone than what is available in the market is coming. So what do? They hold off on their purchases, right? So it is not surprising, or it should not be surprising that Apple will report a lackluster iPhone sale in the quarter before they release the new one. You would think that that would be general knowledge, that that would be information that investors will already know. But that is not always the case. They were still disappointed by that little segment, even though they had beat in every other part. And I'm not even trying to promote Apple stock. I don't hold Apple stock. I don't invest in that company. I've not had it for a while now. So this is just an example that I'm trying to tell you how there are usually market anomalies that as an investor you can take advantage of. So that is why, again, you need to make time to actually look for this information, look for these anomalies, and take advantage of it, right? So now the stock is 5%. I mean, that has provided an entry opportunity. I mean, depending on what your price target for Apple was. I mean, obviously, you can also get that from doing your own due diligence, right? So knowing that information, I mean, you can now decide whether or not this is a good time for you to buy the stock. I mean, because obviously the underlying business and the fundamental of the company has not really changed. Nothing has changed, right? I mean, and obviously it's going to be for the fact that Apple is going to sell more iPhone in the coming year because they just released a very, a very new segment of the iPhone, which is the 5G, the iPhone 12, which has 5G components and all that. So obviously it's going to be one of their very big sellers. So we know that going forward, you have to, Apple will most likely sell more iPhones. So that's the thing. Another thing is that the market is always forward looking, not backward looking. I mean, so you can obviously think that, okay, this quarter that just passed, they didn't sell as much iPhone, but what is going to happen in the future? What is going to happen in the next quarter, in the next year? So you'll be able to make that kind of decision based on the information that you've been able to collect from actually gathering the facts. So that's the second point, get the facts, get the right information. And that way you'll be able to beat the efficient market hypothesis, which always falls short. I mean, as history has predicted. The efficient market hypothesis is not always accurate. Market anomalies are always presented here and there. So you have to use the information to pounce on those opportunities. And that way you can actually invest in very good companies. And the next one is establish rules. So that's the next one. So now you have made time, you've understood the fundamentals of the company, and you're pretty much an expert. You know as much about that company as the CEO of the company, and you're ready to buy the shares and put it as part of your portfolio. So it's always a good practice to establish some rules in your portfolio. And the thing I'm going to tell you about that rule, one of the rules is that, or the most important rule that you can establish for your portfolio is diversity. So you want to have a very diverse portfolio, a portfolio that captures different segments of the market. And another thing is that other than having diversity, obviously you also don't want to over-diversify your portfolio. So you want to keep it to a very good balance, right? because over diversifying your portfolio is actually stretching yourself too thin. Like I see people that have $5,000 portfolios with 100 companies in there. Like you can't possibly tell me that you've done your research on 100 companies and know that much about the 100 companies, right? There is no way, not one person can do that. So for you to actually maintain a decent portfolio, you want to actually diversify. So at least go do your research on different sectors of the market, look for the best companies in those sectors and put it on your portfolio. You don't need to own 100 stocks if you're trading with even $1 million. Like I don't see why you need 100 companies at that point. So diversification is good. Over diversification is also a problem. So you don't want to diversify too much, right? You want to keep the amount of positions in your portfolio to a certain level. So that's one of the rules that you should establish. You should establish that for every amount of money that I have in my portfolio, there's going to be this amount of companies in there, this amount of positions in there. Don't exceed that amount of positions until at least you've been able to grow your portfolio to a certain level. And also, do not over-diversify your portfolio because that way you are stretching yourself way too thin. It is difficult for one person to be able to understand 100 companies. So no one person has any business owning 100 different companies in their portfolio. I mean, if you're going to use that approach, you're probably better off buying an index fund or an ETF. So an index fund or an ETF, they are funds that have been made, they track different companies, right? I mean, the people that are managing that fund, I'm sure they have different staffers, different employees that are actually looking at those different companies and monitoring those different companies. So they are doing your investment for you. That is another way to invest if you want exposure to so many different companies. But if you're one that wants to pick individual stocks on your portfolio, you probably want to keep your position size or your position number to a certain limit. You don't want to exceed a certain limit with your position size. So diversification and over-diversification is a problem that a lot of people have. Like I see a lot of people that have 100% of Tesla stocks, right? I mean, obviously, maybe they believe so much in that company, right? But the thing about it is that no matter how good a company might look at on paper, I mean, you never know what tomorrow holds for that company. Like even after doing your due diligence and doing everything, like doing your research on that company, anything can still happen. There are still so many different scenarios where Tesla can go bankrupt even today. I mean, it's more difficult now than it was last year, but it's still a possibility. So obviously, you don't want to have 99% of your portfolio in just one position. And another thing that you have to do on your portfolio is that you have to have cash on your portfolio. That should be part of your rule. In fact, as a rule of thumb, for me at least, 10 to 30% of your portfolio should be in cash. And by cash, I don't mean actual physical cash. I mean any form of liquid money that you can use and take advantage of immediately when the opportunity presents itself. So 10 to 30% of your portfolio should be in cash to take advantage of opportunities. Because as a matter of fact, the stock market goes up most of the time. Most of the time, the stock market goes up. Most of the time, assets appreciate in value, right? But then there are times where there are market corrections, where there are market crashes, where a recession happens. And guess what? At those times, cash is king. You need to have cash so you can take advantage of opportunities and buy when assets are cheap. Because during a market correction, during a market crash, during a recession, assets are cheap. Those are the times when it's actually best. I mean, if anything, if you're going to change your strategy at all during a volatile market when things are down, you should be buying more, not panic selling, right? Which is what most people do. So most people, when things begin to crash, they panic sell, when in fact you should be doing the opposite. And the thing is that you can only do that if you have the cash to do it. So if you have $5,000, it's probably not smart to put all $5,000 in the market. At every point in time, you want to have 10 to 30% of your position size in cash to take advantage of opportunities when they present themselves. Because you have to think, I mean, honestly, to be successful in the market as a long-term investor, you have to think about crashes. You have to think about corrections as opportunities. That is the only way you can be successful in the stock market. Because historically, I can show you a graph right now. If you give me a second, I'll pull it up. the market goes up. I mean, look at the stock market, at least, I don't know about the Nigerian exchange, but if you look at the American exchange, which I'm sure a lot of you here are interested in, it goes up. Sometimes the corrections and the crashes, you will not even notice them in the long term. They are just noise, right? Because historically it goes up. So if your interest is actually investing for the long term, you should take advantage of those opportunities. I mean, obviously, there are other strategies you could use in the market, like day trading and swing trading. And if that is your strategy, I mean, in fact, for a day trader, you have no business holding your position overnight anyway. And you should also have an exit strategy if you're going to go into any position. But if you're a long-term investor, I mean, you should take opportunity crashes as opportunities. So that should be part of your rule when you are looking into building a successful portfolio. So establish rules, diversify your portfolio, do not over-diversify, and make sure that cash is part of your portfolio. So if any portfolio without cash, 10 to 30% cash, is not diversified enough, period. I mean, because that way you can take advantage of opportunities. And yes, you need to have cash in your portfolio. So that is the third one. So the fourth and last one is adjust, which is A, if it will let me move my, right, so adjust. So now you have made time, you've gotten all the information you need about the stock you're trying to invest in. You have established rules, and you have the stock in your portfolio. Your portfolio is very well diversified, and everything is good. The next one is to adjust. And what do I mean by adjust? By adjust, I don't necessarily mean changing your strategy when things go awry. That is not what I mean here. Like I said before, changing strategies is not necessarily a good idea, and I try not to change my strategy at all. But you have to adjust depending on how the positions in your portfolio move, right? So because there are times where, I mean, you have a position and then you move and becomes too big in your portfolio. I mean, it might be time to rebalance your portfolio. So in that you're adjusting it, because at the end of the day, having a position grow too big in your portfolio means that your exposure or your risk level in that position is increasing as well, right? So maybe rebalancing your portfolio, actually that's a strategy that a lot of funds, like index funds, use in managing their own portfolio. And I usually always say this, that manage your portfolio like it's an index fund. And that way you will never go wrong. So the position, you have Tesla, you bought Tesla when it was $200 last year, and now it's $2,000. So when you bought it, it was 5% of your portfolio, and that was the size that you were comfortable with at the time. And now because it's 10x in a few months, it's now 20% of your portfolio, let's say. I mean, are you comfortable with 20%? Is that part of the rules that you made when you initially bought Tesla? If that was part of the rules, so obviously, like I said in the previous point, to establish rules. So if you're comfortable holding Tesla at 20% of your portfolio, obviously go ahead and do that, as long as you've calculated your risk and you're comfortable with the risk. But then if Tesla begins to grow over the percentage that you're comfortable with, then at that point it might be a good idea, I mean, to at least maybe sell part of it and put it in other things, right? So you can rebalance. So adjusting is usually should be based on the rules that you've established for your portfolio. So you use the adjustment, I mean, to basically make sure that you're always abiding by the rules that you've established for yourself. So that could differ with different individuals. It doesn't have to be the same for everyone. I mean, we could talk offline if you want to know some of the rules I've established for mine. That could be the topic of another discussion. But I mean, as an individual that wants to manage a successful portfolio, you should have some certain rules, and you should use your adjustments to make sure that you're always abiding by that rule. And that way you will not fail. That way you build a successful portfolio. So right now we are 39 minutes in. I think I've touched on all the points that I wanted to touch on today, but there was just one thing that I wanted to say before I open the floor for questions. And this is a saying by Warren Buffett. He says that the stock market is a device for transferring money from the impatient to the patient. And I mean, when I saw this, I mean, I almost, it got me laughing because it's so true. Because how do you actually stay patient in the market? Because most especially, I mean, now in these very volatile times when things go down, like yesterday, I mean, positions were down 10%, 15%, depending on what your investing strategy is. Last week was bad, May, April. Any one of us that were in the market at that time, we realized how bad it was back then. But the thing is that at the end of the day, there were people who sold at the lows, right? And obviously there were people buying. So what did those people do at the end of the day? They transferred their wealth, they transferred money from themselves to the patient. And to be patient in the stock market, you have to abide by those rules I presented earlier. So that is basically what that's why I think that, number one, your strategy doesn't have to change regardless of the situation and regardless of how volatile the market gets. Your strategy remains the same. You remain patient and you end up basically stealing money from the impatient, right? So with that, that is pretty much the end of what I had planned to discuss with you. And I would like to maybe take questions from you now, if there are any.
Yes, thank you so much, Dr. Chalk. That was a very fruitful conversation, and I'm sure everyone here is incredibly blessed to have listened to that. We do have a number of questions. I still see a number of them coming in, so I would begin to take them, and then I have a personal question at the end, if we have more time. And just everyone, just so you know, if you do have a question, please put it in the chat box. I am collating questions there, just in case. I think we actually have about 10 so far. So just go ahead and put it there, and I'm gonna read them, and Chuck would be able to answer them as they come in. So the first question we have here is, what are your thoughts on dollar cost averaging? That is consistently putting the same amount of money in a company every month, regardless of whether it goes up or down. Chuck, if you want me to repeat that, let me know. I think we have his audio disconnected. I'll just give him a second. Okay. Chuck, I think you're on mute. I can read that question again. Let's see. Chuck, can you hear me? I don't think we can hear you. Technical difficulties. I actually don't have you on mute, Chuck. Let me try. Okay.
Hello.
Yes, we can hear you now.
I'm sorry. I lost my audio for a minute, and then when I got it back, I was on mute. So what was the question? I missed it.
Yes. What are your thoughts on dollar cost averaging? That is consistently putting the same amount of money in a company every month, regardless of whether it goes up or down.
So that's a very good question. And like I said in my presentation, dollar cost averaging, it's a strategy that, even Warren Buffett encourages, right? So he likes that strategy a lot. So if it's a company that you are very hopeful on for the future, for the long term, and you believe in its, you believe in the company's business and the company's future, the dollar cost averaging is always a good idea. Personally, I prefer to buy when things are low. So dollar cost averaging, I like like to me, dollar cost averaging, I only like to dollar cost average when the company is below my cost basis, right? I mean, that way it gives me pretty much like, I mean, my money goes a longer way for me that way. So dollar cost average is a good idea. I mean, I don't necessarily use it that well. When I start a position, this is how I can just tell you how I go about my own investing. When I start a position, I nibble into the position and basically establish a cost basis. And then I begin to dollar cost average. So whenever I buy a position, I expect it to fall. Like I'm happy if I buy and it falls. I'm usually not happy once I buy a position and it begins to go up the next day, which happens sometimes, unfortunately. But then I buy a position, and whenever I buy a position, I usually have a target for that position. So let's say I buy a position, I'm like, okay, I'm going to put $200 in that position, and that'll be it. My position is fully built, right, at that point. So I'll probably start off with $20, and then I'll begin to buy incrementally until I get to $200. I mean, sometimes if I really believe in the position and I know that it has the chance of maybe 2xing, 3xing, 10xing in the next 5 years, I would buy I'll buy above my cost basis. But I normally prefer to buy below my cost basis and don't just use an automatic way of investing in that same company every year. I don't like that method. Do I recommend it? I think so. I mean, I think that is an easy, you do your due diligence at the very back end and then just use your research. So obviously you still want to keep track of that company and making sure that the company's fundamentals is still good, right? That is where the information part comes in. So you always want to do your due diligence and always want to continue tracking that company to make sure that your bull thesis and the fundamentals of the company is solid. And if that is the case, and if you decide that the price is still good for you the month after, even though it's gone up 10%, 20%, then obviously go ahead and buy more at that point, because you know that, your target at the end of the day, right? Your target is not for the crumbs. You want the whole loaf. So you want, at the end of the day, to go ahead and buy more. Me, that is not necessarily the way I like to do things. I prefer to dollar cost average when it's below my cost basis, but I can't discourage anyone from buying more above their cost basis if they are very, very bullish on that particular position. It's definitely not a bad strategy, so I'll go for it.
Awesome. Thank you so much. The next question we have here is, what kinds of stocks are best to have in one's portfolio? Dividend paying stocks or?
Okay. Yeah. Is that a question?
Yes.
Okay, good. Yeah. So that is entirely up to you. So different investors invest for different reasons. Investors have different strategies. So some investors are income investors and some investors are growth investors. So the income investors usually prefer the dividend paying stocks, right? Those investors don't necessarily care about capital appreciation. So they don't care if their initial investment, if the stock goes up in price. They are just comfortable receiving the dividend, because most dividend paying stock will pay you a dividend either monthly or quarterly. And that way, some people, what they'll do is that they'll collect the dividend and reinvest the dividend back into the stock, right? So that depends on two things. So it depends on what is your risk tolerance, because the dividend paying stocks are usually more risk-free, if I'm going to put it that way. They usually don't have as much risk as the growth stock, because what they do is that, the investors, the people that are in the stock, they already know that they're not expecting a lot of growth from that company. The company takes their net income and pay a portion of it to their investors in the form of dividends, right? So those companies are usually very stable. They usually don't go through very wild rides. They usually not take you through very wild rides. So it depends on your strategy. If you're an income investor, either way, you're going to build up your portfolio. Your portfolio will probably see capital appreciation. The thing though about dividend paying stocks is that, you have to be very careful what dividend paying stocks that you're choosing, right? And I think that I've actually talked about this in a previous Trove section about dividend investing, if I remember correctly. So there are two things that you need to look for in your dividend paying stock. A lot of investors only look at the yield, the dividend yield. But the dividend yield shouldn't be the only matrix that you're looking at, right? So the dividend yield tells you how much percentage you're going to make from your initial investment every year. So if you have a yield of 1%, you're going to make 1% of your initial investment every year, right? But then another thing that's very important with dividend stocks is that you have to look for the payout ratio. So what is the payout ratio? The payout ratio tells you how much of the company's income they are paying out to their shareholders. So if a company is paying 80% of its income to shareholders, that's obviously a red flag, right? Because that company, they barely have any money to keep to grow the business. And also, if anything happens to the company, the dividend is at risk. They will most likely cut the dividend. And you don't want to be caught holding a dividend stock when the company cuts the dividend, because once that happens, the big institutions that rely on that dividend, they will sell off the stock and you'll be left holding the bag. You will lose capital, huge amounts of capital on that stock, and you would lose a lot of money. So if you're investing in a dividend stock, obviously there are two things that you should be very interested in looking at before you decide to buy that company: the dividend yield, and most importantly, I think, is the payout ratio. So look for that. And if you can do that well, and you know that the company is not giving up all their money to the investors, then you might. Dividend investing is obviously a good and safe strategy to grow your wealth. Because it's at least better than keeping your money in the savings account that will probably pay you 1% interest or 0.5% interest, because most dividend paying stock will probably pay you 2 to 5% dividend yield. So that's a very good way to make money. And if you actually look for the very good dividend stock, most of them can actually appreciate in the position as well. You can actually get some money on your capital investment. So dividend, my strategy, I'm more of a growth investor. I look for more growth companies that have 5, 10, 15 times growth ahead of them. And I prefer a company that don't pay out dividend, because it gives them more money to reinvest into the business than just giving off their money to investors. But those companies come with additional risk. So it depends on your risk tolerance and your strategy. But dividend investing is obviously a good strategy that a lot of people use, and it has worked for a lot of people if you pick the right dividend stock, that is. Did that answer the question?
I believe you did. Thank you. We have a number more, a lot of questions actually, and the questions keep coming in. And if you have more questions, please put them in the chat box. I will be reading them. Okay, so the next question we have is, someone who is a complete novice like me in the stock market, could you, with your experience in investing over the years, recommend at least 5 great companies you have in your portfolio and you're super bullish on?
So that is a question that I was trying to avoid in today's presentation. I wouldn't mind talking individually off the line about some companies that I'm bullish on, but on this forum, I do not want to make any recommendation on a specific company. I can tell you what industry I think has a chance of maybe doing what. So right now, in fact, I think that the stock market is very, very divided right now. So there is the companies that have basically withheld very well during the COVID recovery, and then there are companies that have been beaten down, and remained down. So it's either those or what I call the recovery play. So there are recovery stocks, and there are stocks that have held up during COVID. So what I think, this is just my opinion, what I think is going to happen is that there's going to be a recirculation of wealth in the coming years, right? So those tech companies that have reported very good earnings, those companies that have done very well, during lockdown, companies like like Peloton, for example. So Peloton is this company that makes like workout instruments, and you can buy like really expensive treadmills and use some of their instructors, their online instructors, to do your workouts. So that's a company that has done very well, because obviously a lot of people the gyms were closed. A lot of people have decided to buy those machines for themselves. So they saw exponential growth this year. Is that growth sustainable once the economy begins to reopen and gyms begin to reopen and people are back in the gym? I don't think so. So, I think that those kind of companies are probably not sustainable, and those those growth that they have seen and those appreciation to their share prices that they have seen this year will probably begin to shift to the other recovery plays that are going to benefit from economies fully reopening. So that might be an area where you want to do your research on companies that have actually seen exponential growth due to the lockdowns and due to working from home, and might not be sustainable moving forward, right? So, and companies that will probably benefit from economies reopening in the coming months or coming years. So I will look into that area, and maybe you'll be able to, on your own, find some good companies. If you find some good companies and want me to maybe do some review of those companies with you, I'll be very happy to. In fact, as a matter of fact, I like to hear about people's thoughts on different companies. And what I usually do is that you give me your bull thesis, I'll give you my bear thesis on the company, and hopefully we'll be able to come to a medium, and decide whether or not it's a good investment. I'll be happy to have that discussion with you, but I'm not going to recommend any particular stock. Just look for recovery plays, look for plays that have done well for COVID and might not be sustainable once economies begin to reopen, and you might be able to find some winning positions using that strategy. Hopefully that helps.
Awesome. Yes, it does. And I completely echo the whole spirited discussions with Chuck. He does have a lot of opinions. So if you want to reach out to him, feel free to message me in the chat box or follow Trove Finance on social media. Anything we're going to be doing, I've seen a lot of people asking about the other 3 sessions we'll be having. One is tomorrow. We have other ones next Saturday and Sunday at the same time. If you don't have any information on that, feel free to drop your email address. We will reach out to you. You can also follow us on social media. Every information that we have will be on our social media pages. And you can also join our Telegram group that we have all these conversations all the time. Chuck, we still have a number of questions to go, so please bear with us. Our audience is very engaged. And a lot of people are, giving you kudos and thank you for hosting this session. So thank you. Let's move on. The next question says, at what point is a sell no longer a panic sell in case of a falling trade? Brilliant question.
Oh yeah, I love that question a lot. So there are only 2 reasons that should make you sell your stock. So the first reason is if you need the money. Obviously that happens, life happens, right? So sometimes you need the money and you just need to sell the stock to actually generate that income. So that's the first reason. The second reason is if the fundamental of the business changes, and that happens all the time. So if for example, I'm not going to mention any individual company, but there are companies that actually got affected, like very, very much affected by COVID, and their fundamentals changed. And the companies, the growth areas of that company, the company began to lay off staffs in that area and began to focus on the company that you thought had a lot of growth ahead of them started playing defense, started playing catch up and defense. That way, the fundamental of that company has changed. In a situation like that, it will be okay to sell. Regardless of where you are, it's not panic selling. The fundamentals has changed. You bought the company for a reason. You don't think the company can deliver on that reason anymore. So it's okay to sell at that point. So 2 reasons to sell your stock. You need the money, the business fundamental changes. Other than that, it's probably panic selling.
Fantastic. Thank you so much. If you have questions, please put them in the chat box. The next question is it wise to hold on too long on the ownership of a stock to earn from dividend payouts?
To hold on too long. So what do you mean by, so if too long means that you had a price target on that stock and the stock got to that price target, if that is the case and you don't think that the company had more growth, I will exit that stock, right? Because holding after that is probably holding too long. If you think that the business is sustainable at that point and you don't see any risk to that business and want to collect the dividend, fine. But if you think that the business is beginning to get to a risk level, like let's say their payout ratio is now 105, they are paying you more, the company is losing money and still paying their investors dividends, that's a problem, that's problematic. At that point, you probably want to exit. Because maybe the next quarter, you never know what will happen. When the company begins to get to levels like that, then the dividend becomes at risk. right? The company could cut the dividends at any point in time because they're not actually generating the money to pay out the dividends. So they'll probably cut the dividends eventually, and that would leave you holding the bag. Because once the company cut the dividend, what happens? The big investors, the institutional investors, they exit the stock immediately. And once that happens, the stock crashes, and you're left, holding the bag when you could have exited beforehand. So, obviously, if you had a price target for the stock, and the stock got to that price target, and you don't see any appreciation after that, then I'll exit. Because like JP Morgan said, he said, go as far as you can see, and when you get there, you will be able to see farther, right? So that is my philosophy of investing. So I bought a stock at $15, and I think that the stock can get to $50 in 5 years. So I buy the stock, it gets to $50. Now, do I think that it has any more growth ahead of it at that point? If it does, fine, I'll hold on to it. If it doesn't at that point, at least it's got into my price target when I initially got into that position. So I will exit at that point. So if that was your question, then that's what I'm going to do. But I don't know what you really mean by too long. So, hopefully I answered your question.
I think you did. And if that question wasn't answered, and if that was your question, please go ahead and put some more information in the chat box, and we can see if we have time to take it. At this point, I think it would be worthwhile to mention that we do have the Trove Plus premium features. If you go on your Trove app, if you don't already have that type of information, it should be in the bar to the left on your app, or in the bar to the left on the web. You can kind of do some value screenings and things like that. So to the extent that you want to get more information about a certain stock that you are bullish on, or even just want to get an idea, an opinion on a stock that you're curious about, feel free to use your Trove Plus features. Now we have a couple more questions actually. So the next question is, from your long-term stock trading experience, what are the key metrics and ratio one should look out for on an interested company's financial, playbook, and what are their interpretations? Okay, that is a very huge question, but I guess we can streamline it. So Chuck, how would you say, what are the key metrics that folks can look out for? And I guess we can, later on, you can go and kind of dig deep into what those things would mean, because I think that's a very huge question, but at least you can kind of answer the first part of it. Chuck?
Oh yeah, absolutely. The one I like the best is PE ratio. So price to earning ratio. So price to earning ratio tells you, the price of the stock divided by how much it earns, the earnings per share. So that's a very good one that I like to use. And different stocks has different price to earning ratios, or different price to earning ratios expectation. So for example, the tech stocks they usually trade at a premium because they have a lot of growth ahead of them. So you want to look at where the price to earning ratio of a company is relative to its industry. So for example, you have social media, you have Facebook, you have Snapchat, you have Twitter. Okay, so those are the three main stocks in social media. Facebook is trading for a PE ratio of 25, Twitter is trading for a PE ratio of 40, Snapchat is trading for a PE ratio of 105. The PE ratio of Snapchat is probably too expensive. So at that point, Snapchat is, this is basically just arbitrary numbers, by the way. So Snapchat is probably not the right investment at that point because it's too expensive. Maybe in, let's say, a different industry, automobile industry, the fair PE ratio for this industry might be 9 because the industry don't see as much growth as the social media industry. So obviously, if an automobile industry is trading for 25, even though that's cheap for Facebook, it might be expensive for that industry. So PE ratio, I think, is the biggest, I think is the most important check and balance that you could use to decide on the value of a company at every point in time, compared to the industry of that company, not necessarily just the number. So that's one of the biggest metrics that I use in determining the value of a stock.
Thank you, Chuck. And I think whomever has that question, we actually could do another session on just how to evaluate a company, what to look at, metrics to look at, because I think that would be very important as folks go out there and try to get their information.
You know what? I'll actually be very happy to host that section. And in fact, what I'm going to do is that I'm going to bring in an Excel sheet So this is a model that I use to value my stock, and I will walk you through the Excel sheet on how I go about valuing my companies. I mean, most of it can be very easily replicated. Some of it are just, I mean, maybe something that I've thrown on there and added on there, but a lot of it can be replicated by anybody. So I'll be happy to share that in maybe another section in the future if you really want that. So
absolutely. We're definitely going to take you up on that. We'll talk about the timing and the dates for that. Guys, follow us on social media if you haven't already done so. Once we put that session on, it will definitely be publicized. If you also want to join our Telegram group, I already put that in the, I see folks already telling me that they do want that session. So we will host that. I already put the Telegram group in the chat box as well. So you can feel free to join our community. We still have about 6 more questions. So I'm sorry I am racing through, but let's get through it. What are your thoughts on penny stocks, even in this market? That's the next question.
Yeah, so penny stocks for novice, for amateur, inexperienced investors, I would stay away from penny stocks. So the reason is this. So penny stocks, why are the stocks? So penny stocks, most of them trade over the counter, right? So over the counter stocks, they don't really have any institutional backing. So it's usually, I'll tell you this happens quite a bit. It's usually those stock investment gurus, they're the ones that buy penny stocks. They buy penny stocks, put it out there to their people that follow them, and then those people rush into the stock and drive the price up, right? And then the guru, the institutional guru, leaves the stock, and then the price falls. So basically, what is happening is that he's transferring money from his followers to himself. That's usually what happens with most penny stocks. The volatility is too crazy. It's very risky. I mean, obviously, there are people that have made that. There are some. In fact, I invested in the penny stock recently myself, Planet 13. I was getting desire to invest in that stock with me, but for some reason she couldn't get in. But the thing is that it's very, very risky. That's one thing that I'm going to tell you. And obviously, any money that you put in a penny stock, you should be willing to lose all of it, because penny stocks are very likely to go to zero. Because most penny stocks are companies that have filed for bankruptcy, and the companies are bankrupt. They have filed Chapter 11 bankruptcies. So what they are doing is that the stock are still out there. People are still trading on the stock just to speculate and just to make quick money. Most people in penny stocks are not there for the long term, right? So you can very likely be left holding the bag, because the big smart money would leave unexpectedly and the stock will crash and you'll be left holding the bag. It will never go up to its original value. So that's the problems with penny stock, and I'll stay away from it as an amateur investor. You need some level of experience to actually perform well in penny stocks. And I will not use penny stocks as a means of long-term investing as well. If you're someone that is very well versed in day trading and swing trading, penny stocks might be a good strategy for you. Obviously, you should have your stop losses in place. You should have your exit strategy in place, but that will not be a good, sustainable way to build a long-term portfolio.
Awesome. Thank you for that. Let's move on quickly to the next question. Hi, Chuck. Please, what are your thoughts on ex-dividend period?
For what?
Ex-dividend period. So I assume that means that what are your thoughts on, post-dividend?
Okay. Yeah. I mean, so if you're a long-term investor, ex-dividend period is meaningless. It shouldn't mean anything to you. The thing about ex-dividend is that if you're a short-term investor, obviously, they want to invest for the dividend. The thing is that a company is going to, investors are going to put a premium on a stock before it pays its dividend. That's just the way it is. And then after it pays the dividend, investors are going to exit the stock. So there's usually a premium before the dividend is paid, and that premium goes away after the ex-dividend date. So after the ex-dividend date, very likely the stock will at least drop to a certain level. But as a long-term investor, that shouldn't bother you at all. If you're a short-term investor banking on just being in a stock for a certain period of time and getting the dividend, obviously you need to play that very, very smartly, right? You need to enter at the right time, calculate. I mean, you have to do some statistical analysis before you get into that stock as a short-term investor. And in fact, since this stock is mostly focused on long-term investing, I would just say ex-dividend is meaningless. Ex-dividend date is meaningless. It's just the day after you are. So basically, every investor prior to the ex-dividend date get paid the dividend. If you enter the stock after a day after the ex-dividend date, you don't get paid the dividend for that quarter. That's what ex-dividend means, right? And because of that, there's usually some minor movement in the stock around that time. But as a long-term investor, it should be completely meaningless to you.
Noted, noted. Thank you. So the next question is, as a novice to the stock market, what do you recommend as the first step to invest in? Apologies if you covered this earlier and I missed it.
Okay. Yeah, so the first step to investing obviously is to educate yourself. I think I did cover it. I mean, obviously this talk is very high level, very philosophical. It doesn't really give you any practical approach to actually go. But I'll tell you what I used to, start. But at one point I was a novice. I didn't know anything about the stock market. I was just someone that started making more money than I was making initially. I wanted to actually start making the money work for myself. That's how I got into investing. I was a grad student. As a grad student in the US, you get paid a stipend. It's usually $25,000, right? You get paid a stipend, you're not making any money, you're just enough to live. And then after I got out of grad school and got into the industry, I saw a significant appreciation to my income. And then I wanted to be able to do something with the additional income I was making. And that was how I got into the stock market. And what I did was I just want to educate myself. There's so many books out there that you could read. Smart Investor. There's Understanding the Market Cycle. So educate yourself. Look for resources out there. Look for books. Look for, right now the internet is very available to all of us. There's a lot of information out there. So go out there, look for information, and look for how people have done it. And after you've actually understood how the market works, so that's the first thing that I would like to that you should probably do. Understand how the market works. Learn all those terminologies with stocks. Like, okay, what is a bull market? What is a bear market? All those little things. So learn all those terminologies. And then after doing that, as a new investor, you probably want to start with companies that you already use, you already know. So that's a way to actually start. So start safe. You have an Apple phone. Apple is obviously a company that will be on your radar as a new investor. So go look into Apple and see what they are doing. Go to their investor relation page. Every company that trades in the stock market has an investor relation page to basically update their investors on how the company is performing. So look at what the management is saying. Look at look at their financial reports. Obviously, also look at the management. I didn't emphasize this previously. Look at the management of a company. So Google any company you're interested in buying. Google their management, Google the CEO of the company, look at his background. If a CEO, for example, is running a pharmaceutical company and he has an accounting degree, that should probably be a red flag to you. So look at that, look at those little information, and then you'll be able to start deciding on what companies to do to invest in. And then, obviously your skill set will grow from there. But as an initial investor, I would advise that you should probably start with companies that you already use and that you're already very familiar with. It could even be the company you work for. That is probably a good place to start. You know the business of that company very well. You're a participant in the business. Maybe obviously in the future, I'll probably advise you not to stay too long in that company because I like to, for example, coming back to the point I made earlier, diversify, right? If the company is the source of your income, you probably don't have it on your portfolio anymore. In that case, you're overexposed to that industry. But that will probably be a good place to start as an initial investor. Buy things that you use, buy companies that you know very well, and you already use their product. So, and then you just go from there. You will learn more on the way. You will learn along the way. With experience, you will begin to see how to look for other companies. You'll be looking for exactly the same matrix with other companies anyway. You just probably need to go and find those companies and then look for the same things that you looked for in your initial investment. And it's going to work out from there. The rest will take care of itself. Experience, like they say, is the best teacher. So once you get started, you will probably develop the experience you need.
Awesome. So just because we are short on time, we have 5 more questions and that's all we're going to take. If you have any additional questions, please shoot an email either to hello@troveapp.co or join the Telegram group and you can put your questions in there. Dr. Chuck will be available for a couple hours today and I totally just volunteered him to do that. But we can take other questions offline. Okay, so let's quickly jump to the last couple of questions. Which country's stock market do you advise one to trade in? Is the Nigerian stock market advisable?
So I'm going to say this. I know absolutely nothing. I have zero knowledge on the Nigerian stock exchange. So I do not invest in Nigerian companies. Unfortunately, I would like to grow my knowledge in that space, but I don't know. I don't know anything about Nigerian stock exchange right now. So I mostly invest in American companies. I mean, I live in the US right now, so those are the companies that I know. So that's where I invest in for the most part. American companies are usually very good to invest in. I mean, the American economy is very good. If you look at the history of the stock exchange in America, go look at the S&P 500 history, it's always upward trending, right? You can't necessarily say that about the Nigerian stock exchange. However, the Nigerian stock exchange is on that turnaround right now. It's going through turnaround, which is good. I mean, it probably has some very bright future ahead of it. But I don't really know much about the Nigerian stock exchange. So I mostly stick with American companies, and then I invest in some Chinese companies through ADRs. But mostly I trade in the American stock exchange. So that's all I know.
Fantastic. Thank you so much for that. The next question says, what can you say about buying stocks of pharmaceutical companies about to go through an FDA approval?
Yeah, so that is speculation, right? So you're making a speculative play. So if you want to do that, there's nothing wrong with that. I made one recently myself and it didn't work out. So I'm not going to advise against it. You should know though that going into it, it's speculation. So you should obviously limit your exposure to it. Like for speculations, I don't expose myself over 2% of my portfolio for speculative plays. So limit yourself to the exposure and also have an exit strategy, have a stop loss set. So once it doesn't work out, you don't get left holding the bag, right? You exit immediately. So have a stop loss. I mean, I don't know if Trove has that feature. I'm sure it does. It should. So whenever you buy this kind of stuff, put a stop loss. Put a stop loss on it. Like, okay, you're like, I'm entering at this price. Once it gets to this price, let's say it falls below my cost basis to this price, I'm going to exit at that point and don't look back with speculative plays like that. Because, I mean, usually those pharmaceutical companies that go through FDA approval, they undergo very wild swings, right? Because day traders trade off of those kind of information. So you don't want to be left holding the bag. So those are speculations. Limit your exposure and have an exit strategy. Those are the two things I would do for this kind of plays.
Awesome. Thanks for that. The next question says, what is your opinion on increasing number of shares by selling a stock ATH and hoping to buy back once it pulls back?
That's a bad strategy. That is the worst strategy ever. Because like I said, you can't necessarily predict the future of a stock. Most fund managers and most investors, they fail at that mission, right? So if you believe in the company long term, the stock is trading at $40 today, and you think it has the potential to go to $100, and the fundamental hasn't changed, no matter what. I mean, even if you think, like sometimes the technical analysis is not always right, statistical analysis is not always right. Sometimes the technicals might tell you that, okay, there will be a correction coming up in 2 days. That doesn't always happen. Sometimes it breaks out of that pattern and continue going up. So if you're still bullish on the company, like I said, hold on to it and wait for your bullish thesis to play out. Selling a stock and hoping for it to fall so you can buy lower is a very bad strategy. I mean, honestly, everyone falls for that strategy. I fell for it at one point this year, and I'm going to advise you against it. It's not a good strategy. Do not do it. Only reason to sell your stock is if the fundamental of the business changes or if you need the money. Don't sell your stock with the hope of buying lower. That's a bad strategy. It doesn't work out. It's not sustainable.
Awesome. 2 more questions and it would be a wrap. What is your take on the renewable energy industry, especially if Biden wins?
Especially what?
If Biden wins, Joe Biden.
Oh, if Joe Biden wins. Oh, awesome. I love that question. So if Joe Biden wins, I mean, obviously that is going to be very good for the renewable energy company. I can tell you this. I mean, obviously I'm in that space right now. The renewable energy companies right now, they rely on credits to make a profit. Renewable technology is not at a place right now where on its own it can make profit. So for a renewable energy company to make any income, any money whatsoever, they need government credit. So what government does is that, or what the United States government and the EU, the European government as well, I mean, it's not that, actually the American government don't do this a lot, it's just California that does it right now. So they give credit based on how much carbon that you're emitting, right? So if you, so there's a level, there's a threshold. If you exceed that threshold, you get charged a fine. So pretty much you pay a tax on the extra carbon emission that you're emitting to the atmosphere. And if you go below that threshold, then you get what is called a low carbon credit. So you've reduced your carbon emission, you're going to get a credit from the government on that. So under a Democratic presidency, you're most likely, this is opinion based right now, I'm just speaking based on opinion. You're most likely, I mean, the Democratic presidency, they are more environmentally friendly, and they are more likely to adopt those European laws on carbon credits. I mean, right now it's only in California. It's called the LCFS, the California Low Carbon Fuel System in California. They are most likely to adopt that and make it more federal, such that renewable companies are going to benefit from the reduction in their carbon emissions and most likely make more profit, and the stock will most likely go up. Under a Republican presidency, is going to be, at least the pushing those kind of policies is going to most likely be more delayed, and it will be a lot slower for it to actually pass under Republican presidency. But then again, you have to think about it this way though. So presidency, usually the stock market has likes, checks, and balances. So it's not just about who wins the White House. You also have to think about who wins the Congress, who wins the Senate, because at the end of the day, for anything to pass, I mean, those people have to be on board. So, I mean, if a Republican wins and you have a Democratic Congress, that could also affect how things play out, right? So at this point, I will not necessarily make any investing decision based on the election outcome, because I really want to show this chart. Give me one sec if I can find it. Okay. Because honestly, in the long term, elections don't have, I mean, whoever is in the office doesn't have any impact on the stock market in the long term. I mean, but in the short term, I mean, I guess the renewable companies might benefit from a Democratic, I mean, maybe presidency and Congress. So it depends. It depends at the end of the day. I mean, you have the White House, you have the Senate, you have the House. Those three are the things that you have to actually look for. So, I mean, a Democratic president might not mean anything if we have a Republican Congress. But I mean, like I said, I think that the important information that you need to know here is that the renewable energy industry right now is reliant on those credits for them to actually make a profit, and they might probably do well under a Democratic president. But then you have to think about it this way too. I mean, because at the end of the day, where is the credit coming from? The credit is coming from taxes. So corporate taxes, payroll taxes, individual taxes. So the Republican presidency, for them to be able to afford those credits that they gave to renewable energy companies, they might have to increase taxes, corporate taxes, payroll taxes. And I mean, increasing corporate taxes, payroll taxes is not necessarily going to do very well for the economy. So I mean, at the end of the day, it might even be an effect that we don't even see. They might cancel out each other. You increase taxes, you increase renewable energy credit. You might not see the net impact at the end of the day. So honestly, I will not necessarily trade based on the election results. I think that's a bad idea. If you like renewable energy industry because of the future you see ahead of them, which is actually a very bright one, I can tell you that being in the industry, then go ahead and do that. If you're only investing in it because you think a Democratic president is going to win, it's probably not the smartest idea. I don't want to complicate the chart with trying to share my screen, so I will just leave it. Just Google stock S&P 500 performance under Republican or Democratic presidency, and you will see a chart. It shows you how the stock market appreciates under both Republican and Democratic presidents. It will shade it in red and blue, and you'll be able to see that the stock market, it has no long-term impact whatsoever on the stock, on the overall market, and even on individual industries. So a Democrat wins tomorrow, the stock market might go volatile for 2-3 months, the stock market is they have a very short memory, right? In a month time, we'll forget about the fact that we have a Democrat in the office, and we'll remain focused on the company's fundamental at the end of the day. So I'll not really make any decision based on the election results. I don't think that's a good strategy. Renewable fuels in general, I like it. I like that industry. I'm actually looking into it myself right now. I'm not exposed to that industry on my portfolio right now, and I'm looking to actually start gaining some exposure to it myself. So I'm doing some research myself, and I'm liking what I see. So it has a bright future ahead of it.
Awesome. Thank you so much. And the last question is, you talked about having cash for about 10 to 30% of your portfolio, but not liquid cash. What does that mean, and where can we keep this cash in our portfolio?
Okay, so yeah, what I mean by cash, I actually do mean liquid. It has to be liquid, right? So that's what I mean by cash. So if you have, I mean, depending on what portfolio, if you have Robinhood, for example, I don't use Robinhood, but if you use Trove, for example, let's say, I don't know what Trove does with your cash position, but one thing you could do is that you could leave it on there. You could leave Trove. I mean, at the end of the day, it's going to be a net. If you leave it on cash, your cash will do nothing. It will remain just cash. It's not going to fall during a stock market crash. It's not going to appreciate if the stock market goes up. It just remains flat. And when it's time to invest, when you see an opportunity, you immediately pounce on that opportunity. Another way to actually save your money is savings account. I mean, there are savings account out there that pays pretty decent interest. I mean, put your money in savings account. Those money are still classified as liquid cash. So whenever you need them, just by liquid cash, I mean money that you can take advantage of immediately when the opportunity presents itself. You can easily get the money. Like obviously, if you have your money somewhere tied in a property like a watch somewhere, you might not be able to find a buyer for that watch when you see opportunity in the market immediately. So that is not considered liquid. By liquid, I just means money that you can immediately take advantage of. It could be in a savings account somewhere. It could be in a money market somewhere. It could be just cash in your portfolio. It could actually be physical cash where you could just go to an ATM, put it in there immediately, deposit it to your account, however you want to keep your cash. But 10 to 30%, I think, is a good way to make sure you can take advantage of opportunities. But opportunities present themselves all the time, so you want to make sure you can take advantage of those opportunities when they come.
Sounds awesome. Thank you so much, Dr. Chalk. And just to comment on that, you can actually keep your money in your Trove wallet, and it should, be available to you. Remember that if you don't do your instant deposit, it might take a couple of days to get your conversion from Naira to dollars. So just keep that top of mind as you are kind of building out your portfolio. But Chalk, we are incredibly grateful for this amazing session. I mean, if you look in the chat, everyone has been saying really, really good things. So thank you so much for sharing your expertise. We are going to take you up on the offer to host a couple more sessions for us, but you and I can talk about that offline. And thank you guys so much for spending all this time with us. We really appreciate it. I hope you've been able to take something away from this session. This session will be available on our YouTube page, and we'll publicize that on our social media pages and in our Telegram group. Again, if you have any questions for Trove, please feel free to email us at hello@troveapp.co, or say something on the Telegram group, or send us a DM, or an Instagram message or something like that. But without further ado, I also gleefully invite you to our session tomorrow at the same time, 5 p.m. West African time, with Gerald Gooden. We're going to be talking about investing for the long term post-COVID. So that would be another interesting and amazing session. Gerard is a Wall Street associate that has been doing incredible things for a couple of minutes now. I actually knew him at Goldman Sachs, and I know that he's incredibly intelligent. So looking forward to seeing you guys tomorrow. And with that, I think we can drop the mic. Thank you, guys.